$900 trillion. I mean, I want you to just hold that number in your head for a second, because that is the scale of the transition we're talking about today.
Yeah, it's a number so large, it's almost, abstract. It represents virtually the entire global traditional economy.
Right. And it's about to undergo the most massive technological rewiring in a century. If you stand in the middle of any major city and look up, you're immediately captivated by the skyline.
Oh, for sure. The big glass skyscrapers.
Exactly. You see these glittering skyscrapers catching the light. It's flashy, it's visible, and it's what everyone in the financial world takes pictures of. But those buildings wouldn't last a single day without the invisible underground city right beneath your feet.
The plumbing, the electrical grids.
Right. The water mains, the high voltage conduits. It's not glamorous. I mean, nobody is taking selfies of the sewer grate. But it is the sheer, undeniable reality of how the city actually functions.
And if you want to know where that city is expanding next, you don't look at the sky. You have to look at where the engineers are laying down the new pipes.
Which brings us to our mission for today's deep dive. We are stepping completely away from the glittering, highly speculative, and frankly, noisy skyline of crypto hype. We are going underground.
I love that. Going into the structural foundation.
Exactly. We're looking at the structural, inevitable future of global finance over the next decade. We have this fascinating stack of investor predictions mapping out major trends for something called RWA adoption through the year 2035.
And it is crucial to understand from the outset that the next 10 years of this tech, well, they won't be defined by internet memes or wild retail market cycles. The next decade is going to be defined entirely by infrastructure, by regulation, and by these massive tectonic shifts in global capital flows.
Okay, let's unpack this, starting with that acronym, RWA. Real-world assets. Based on our sources, when we say RWAs, we aren't talking about digital art or speculative tokens, right?
No, not at all. We are talking about the bedrock of the global economy. So government bonds, private credit, commercial real estate.
Right. Money market funds, commodities, equities. This deep dive is basically your shortcut to understanding where the world's actual money is moving right now.
It is the digitization of the traditional economy.
Yeah.
And the first major trend outlined in our source material is what they are calling the great migration of yield on-chain.
Yeah, the sources point out that tokenized treasuries, which are essentially U.S. government debt represented as digital tokens and short-duration credit, they're rapidly becoming the default cash management tools.
For massive entities, too. We're talking corporations, traditional family offices, fintech companies, and DAOs.
And just for you listening, a DAO is a decentralized autonomous organization. It's basically an internet-native company run by smart contracts and code rather than a traditional CEO and board. And they are all looking to park their cash in on-chain yield.
Which represents a really fundamental shift in how treasury management works. Historically, parking corporate cash in short-term government instruments involved a ton of friction.
Oh, yeah. Dealing with brokers and settlement clearinghouses.
Exactly. Time delays, business hours. But when you move that yield on-chain, you're streamlining the entire process of how these organizations manage their most liquid capital. The token itself accrues the interest to 247 without all those intermediaries.
I look at this shift like the transition from mailing physical checks to setting up direct deposit. I mean, remember writing a physical check, stamping it, trusting the Postal Service, and then waiting 3 business days for the funds to actually clear your account.
A nightmare compared to today.
Right. Direct deposit didn't change the money itself. It was just a faster, infinitely more logical way to move it. But that makes me wonder, is this just about speed? Because if we are just taking the old system and making it a tiny bit faster, that doesn't seem revolutionary. Does tokenizing an asset actually change the fundamental nature of the credit itself?
What's fascinating here is that it absolutely alters the mechanics of the asset, particularly when we look at the next big trend from the sources, which is the rise of private credit as the flagship real-world asset. It goes far beyond just settling a transaction faster. Tokenization supercharges private credit, which, by the way, is already the fastest growing asset class in the traditional financial world.
Okay, I need you to break down the mechanics of that. How does turning a massive corporate loan into a digital token actually supercharge it?
Well, let's look at how traditional private credit works today. If a mid-sized company wants a $50 million loan, the origination costs, like the fees and administrative burdens just to create the loan, are incredibly high.
I'm guessing a lot of paperwork.
A mountain of it. You have armies of lawyers drafting covenants. You have massive paper trails, escrow agents. You've got siloed databases at different banks that don't even talk to each other.
Right.
But when you tokenize that credit, you encode the rules of the loan directly into a smart contract on a blockchain.
Wait, so the code itself acts as the escrow agent and the lawyer. It just executes the terms of the agreement automatically.
Exactly. And that drastically lowers the cost of originating the loan. But it also changes the servicing of the loan. Instead of waiting for, say, an auditor to generate a quarterly PDF report to see how a portfolio of loans is performing, the data is live on the ledger.
Oh, wow. So payments are routed instantly.
Instantly, straight to the token holders. And the compliance checks, like making sure the borrower is maintaining certain cash reserves, those can be read automatically from their on-chain accounts.
That makes total sense.
Yeah.
You're stripping out the middlemen and the manual auditing entirely.
The efficiency gains are so profound that the sources make a massive prediction here. They say tokenized private credit may actually outscale tokenized government treasuries by the year 2035.
Outscale treasuries. That is staggering.
Right.
And I mean, it leads us to a really clear realization. If the basic plumbing of credit and corporate cash management, which is the absolute lifeblood of global business, is moving on-chain for efficiency, it's only a matter of time before the rest of the traditional financial world follows suit.
Right.
We really need to look at the sheer mind-boggling scale of what is about to be tokenized.
Yeah. The sources explicitly refer to this dynamic as tokenized markets outgrowing native crypto markets.
Here's where it gets really interesting, because the sources state that the global RWA market is valued at roughly $900 trillion. And I really want that to sink in for the listener.
It's hard to even wrap your head around.
It really is. To put that in perspective against the crypto market you read about in the news, Bitcoin, Ethereum, the highly volatile stuff. If native crypto is a group of engineers in a closed room trading rare digital trading cards with each other, the $900 trillion RWA market is the deed to the building they're sitting in.
That's a great way to put it.
It's the power grid keeping their lights on. It's the mortgage on the coffee shop across the street. The real world is the prize here.
Yeah, and the sources even call native crypto a rounding error by comparison. Tokenization isn't about creating new speculative coins. It's the infrastructure bridge built to bring that entire $900 trillion ocean of traditional value into the digital age.
I have to push back on this, though. Wall Street has armies of quantitative analysts who hunt for fractions of a penny in arbitrage. If this RWA market is so huge, and the efficiencies you just described, like the lower origination costs, the automated servicing, the real-time data, if all that is so wildly lucrative, why hasn't traditional finance already swallowed this whole?
That's a very fair point.
Because Wall Street does not leave money on the table. So what is the actual holdup?
Well, that is the trillion-dollar cushion. You simply cannot bridge a $900 trillion ocean using experimental technology alone. Institutions of that scale, they don't move based on theoretical technological efficiencies. They move based on absolute ironclad guarantees.
Right, because if a smart contract managing a $50 million real estate loan has a bug, or, I don't know, the borrower defaults, code cannot physically repossess a warehouse. You need lawyers. You need courts.
Exactly. You need a legal framework that recognizes the token as the definitive proof of ownership. Traditional finance hasn't swallowed this whole yet because managing a market of that size requires structural guarantees, enterprise-grade security, and above all, clear rules of the road to manage systemic risks.
So the stakes are just too high.
Way too high. If a major tokenized credit protocol collapses, you don't just lose internet money, you could trigger a real-world liquidity crisis.
Okay, so what does this all mean? Normally, when you hear the word regulation in the context of technology or finance, it's framed as red tape, right? It's bureaucracy that slows things down and kills innovation. But the sources are calling this next trend a global RWA arms race created by regulation. Are countries actually competing to attract this tokenized capital?
If we connect this to the bigger picture, you have to realize that major global powers are actively vying to become the foundational financial hubs of the 21st century. Regulation, in this context, it isn't a stop sign, it's a blueprint.
Oh, interesting.
Yeah. The sources highlight 4 distinct approaches happening globally right now, and each is building their own structural rails to capture this massive $900 trillion migration.
Let's break those down. The sources mention the European Union first, I think.
They do. The EU is focusing on highly structured, comprehensive frameworks. Think of their MiCA regulations. They're attempting to provide absolute legal clarity from top to bottom, essentially writing the entire massive rulebook in advance.
Okay, getting all the parameters set before the game even starts. Then you have the UK, which the sources describe as taking an innovation-driven model, right?
Right. Instead of writing the whole rulebook up front, they're leaning into a more agile approach, building regulatory sandboxes.
Meaning they let financial institutions test how these tokenized assets behave in controlled, monitored environments to see what rules actually need to be written.
Exactly. It's a much more iterative process. Then there is the United States, which obviously has the largest traditional capital markets in the world by a wide margin. The U.S. approach is described as enforcement heavy.
So regulation by litigation.
In many ways, yes. Because the U.S. market is so massive and lucrative, the regulatory clarity is currently being established more through legal actions, court rulings, and enforcement precedents, rather than, preemptive, sweeping legislative frameworks like we see in the EU.
Got it. So if the EU is trying to write perfect rules up front, and the U.S. is relying on courts to set precedents after the fact, Asia must be looking at this as a massive arbitrage opportunity to step in and capture the market.
That is precisely what the sources indicate. Asia is operating on hybrid regulatory systems. Various jurisdictions like Singapore, Hong Kong, and Japan, they're blending different aspects of these models.
Just taking what works.
Right. They're moving very quickly, providing targeted clarity to capture institutional capital flows. They're really positioning themselves as highly efficient, digitally native financial centers.
It really is an arms race. But, looking at these 4 completely different approaches points to a glaring structural issue. If the EU, the UK, the US, and Asia are all building their own separate, heavily regulated, geographically isolated systems for tokenized assets, aren't we just building digital islands?
It's a massive risk.
Yeah. There's a massive risk of global fragmentation here. How are these distinct legal and technological systems actually going to talk to each other?
Well, that is the exact friction point that leads to the next major trend in the source material, which is interoperability becoming the new global liquidity layer.
Yeah.
Because you hit the nail on the head.
Yeah.
A globally tokenized economy simply doesn't work if an asset minted under the EU's strict legal framework can't seamlessly be traded or utilized as collateral by an institution operating in an Asian jurisdiction.
It makes me think of traveling internationally with your electronics. Like, you could have the most advanced, expensive laptop in the world, but if you land in a different country and you don't have that universal power adapter, your device is basically a brick. You cannot tap into their grid. Interoperability is the universal adapter for global liquidity.
That is an excellent way to conceptualize it. And the sources point to massive breakthroughs required and that are currently happening in several key areas to build that adapter.
What kind of breakthroughs?
First is cross-chain messaging. This allows completely different blockchain networks to securely communicate state and value to one another. Second is unified identity solutions. So investors' credentials can be verified across borders without having to start the onboarding process from scratch every single time.
Oh, right. The KYC, your customer protocols. If you pass compliance in one trusted framework, that proof just travels with your digital identity.
Exactly. And that leads to compliance-embedded tokens. This means the complex regulatory rules we just talked about, the EU frameworks, the US restrictions, they're actually baked into the token's code itself.
Wait, really?
Yeah. The token inherently knows if it's allowed to be traded by a specific entity in a specific jurisdiction.
So a tokenized U.S. real estate asset can't accidentally be sold to a sanctioned entity overseas, because the token itself will literally fail the transaction at the code level.
Yes, exactly. And this all culminates in chain-agnostic settlement, meaning the buyer and the seller don't even need to care what underlying blockchain plumbing is being used. The transaction just settles instantly, legally, and across borders.
Yeah.
But building that seamless, interconnected web brings us to the final and perhaps most disruptive trend from the sources, which is the convergence of retail, institutions, and AI.
Okay, if interoperability is the universal power adapter for global liquidity, where does artificial intelligence fit into this? Like, is AI the user plugging it in?
Well, this raises an important question about the sheer complexity of a multi-chain, multi-region, mathematically continuous financial system. Think about all the variables here.
It's a lot.
We're talking about $900 trillion worth of traditional assets moving across fragmented but interoperable digital networks, constantly adjusting for yield, risk, macroeconomic shifts, and compliance in real time. That system is vastly too complex for human beings to optimize manually.
We just don't have the processing power in our brains. I mean, a traditional hedge fund manager cannot track 1,000,000 different variables across 50 different global ledgers simultaneously to find the best yield.
We just can't. And that is where the source material provides what I think is a brilliant synthesis. The quote is, tokenization gives AI the data. AI gives tokenization the intelligence.
Oh, I like that. Let's really dig into that. Tokenization gives AI the data because right now, traditional finance data is incredibly messy, isn't it?
It's notoriously messy. Traditional finance is plagued by siloed databases, delayed reporting, different accounting standards, and, literal PDF files being emailed around.
Right, just sitting in someone's inbox.
If you point an AI at that, it hallucinates or makes poor decisions because the underlying data is fragmented and stale.
But because every tokenized real-world asset operates on a blockchain, it has a clean, standardized, constantly updated, mathematically provable data feed.
Yes. Tokenization cleans the data and standardizes it globally. It provides a perfect real-time state of the market. Once you have that pristine data layer, AI can actually be deployed to do what it does best: analyze complex portfolios instantly. It can automate risk scoring based on thousands of live on-chain parameters.
I see where you're going with this. The AI can look at a low-yield tokenized bond in Europe, recognize a higher-yield private credit opportunity in Asia, verify that the compliance-embedded tokens allow the trade, and execute the routing of that capital in milliseconds.
Precisely. AI becomes the central nervous system of global finance. The physical infrastructure, the ledgers, the smart contracts, the interoperability protocols, those are the pathways. But the AI is the intelligence navigating those pathways at speeds and scales no human institution could ever match.
Bringing this all together, this completely validates the mission we set at the start of the deep dive. The next decade of finance is structural, not speculative. We aren't talking about trading digital pictures. We're talking about the complete rewiring of how global value is originated, managed, and traded.
It is a profound shift from analog, fragmented, human speed systems to a unified, intelligent, digitally native framework.
And this is exactly why this matters so deeply to you listening to this right now. Whether you're managing a corporate treasury, whether you're prepping for a high-level finance meeting, or you're just insanely curious and trying to understand the future of digital ownership, these are the invisible rails being built onto the global economy right this second. We've seen the migration of yield to on-chain efficiency. We've looked at the rise of private credit governed by smart contracts. We've conceptualized unlocking that $900 trillion ocean of traditional assets. And we've mapped the regulatory arms race shaping the rules. Interoperability connects those digital islands, and AI acts as the omnipresent brain optimizing the entire system.
The structural pieces are all rapidly moving into place. But, synthesizing these sources leaves me with one final lingering thought to mull over.
Okay.
Well, we've established that the ultimate endgame here is the entire $900 trillion world of real-world assets becoming tokenized. They'll be fully interoperable across borders and intelligently managed by AI algorithms that automatically route yields and score risks with perfect data.
Right, the fully realized vision of 2035.
So if the system becomes that perfect, that fast, and that fully automated, what happens to the traditional role of the human investor? Yeah. By the time we reach 2035, will human beings actually still be making active financial decisions? Or will we just be sitting back, simply setting the overarching parameters like our risk tolerance and retirement dates, while we watch artificial intelligence trade the world's underlying assets at the speed of light?
That is a wild thought. When the underground city is finally finished, are we the architects or just the spectators at the new skyline? We'll leave you to think about that. Thanks for joining us on this deep dive, and we'll see you underground next time.
1